Welcome back, ladies and gentlemen, to the Capital Control Show. I'm your host, Derek Gruning. I have a quick favor to ask of you. Can you please like, share, or subscribe to the channel and the podcast as we continue to develop new episodes each and every week? We hope that you're gaining value from this and find this information insightful and would like to share it with your friends and family. But it certainly helps us continue to grow and expand and offer more informational content for you. And once again, we just want to say thank you already for watching the episodes and showing your support. But please go ahead and like, share, and subscribe because it will help us continue to grow. In this episode, we're going to be talking about the ideal savings strategy, and in particular, how we can utilize the infinite banking concept to develop this strategy for saving for the future. Now, there's a couple caveats that we need to introduce here from the outset. Saving is not investing. And utilizing an infinite banking type life insurance policy is also not an investment, but it is seen as a savings tool. So what we're going to do in this episode is compare dividend paying mutually owned whole life insurance, the way that we would design it for the purposes of becoming your own banker. Compare that to what other alternatives are there in the marketplace as a savings strategy, and to see just simply which one wins out at the end of the day. So I hope you enjoy this episode and this content. Let's keep moving forward. Last episode, we introduced the idea of family wealth planning and thinking of your family and your legacy bank. And in that episode, we outlined the 5 phases of family wealth planning. The first one being that you need to save. Now, the question generally is how much do I save? Or how much of my income or percentage of my income can I save? Or how do I save? Where should I save my money? These are all great questions and ones that we're hoping to address here today in this episode. Once again, saving versus investing. These are 2 different categories or frames of thought. And here's a definition of investing from investor.gov. It says, in finance, risk refers to the degree of uncertainty and or potential financial loss inherent in an investment decision. Now, this definition speaks more broadly about risk in general, as opposed to investing. But as you invest capital, there is a risk involved in it. And that risk means that there's a degree of uncertainty or potential financial loss. And in general, when you're investing, you want your reward to also match or exceed the level of risk that you're taking on. But when you're saving, you're doing it in an environment that's relatively safe and stable, that isn't volatile, such as the stock market or even the real estate market. These are seen as more, quote unquote, guaranteed types of returns or a safe return. But there is an important rule in life, and this is taught by Nelson Nash. He would tell us that your wealth must reside somewhere, or your cash needs to live somewhere. Now, some people stuff their cash literally underneath their mattress, or in the walls of their house, or in a tin can in the backyard. And other people, they choose to save their cash, make it live inside of a commercial bank. There are many different products that someone could save their cash inside, such as a savings account, or a money market account, or a certificate of deposit. Even federal bonds, it could be seen as a product or a place of where they would save their capital until they're ready to use it. And in this episode, I'm really talking about short-term saving strategies. Now, of course, for many of us, it might take several years before you make your first large investment in, say, a piece of real estate. But in the short term, what are you doing? In the short term, most people want to keep their capital outside of the stock market because of how volatile it is. There is no guarantee that when it comes time for you to pull cash out of the stock market, that it doesn't also all of a sudden drop 5, 10, 15%. And so that's why many businesses and many individuals keep their funds away from the stock market and away from the volatility in order to have some sort of stability and guarantee that the cash can be accessible when they need it without jeopardizing it to the risk of the stock market. So here are, once again, a few examples of where people save their dollars. If you're saving at a commercial bank, it could be in the form of a traditional savings account, which generally has paid out terrible rates of return as of recently, but so has a checking account. And money market accounts are making a bounce right now, where many people are putting their dollars, their liquid capital, in money market accounts. or even a certificate of deposit. Now, for those of you who may be unfamiliar with what a certificate of deposit is, it's you pledging your dollars to the bank for a certain period of time, and in return, the bank will pay you a return on those dollars. Now, they could be 1 month, could be 3 months, could be a year, maybe even 5 years, if not even longer. But the important thing to note here, with all of these different strategies of saving at a commercial bank, that these are all taxable. Now, you could utilize retirement funds or a retirement account and have funds in a certificate of deposit inside, say, a Roth IRA. That is feasible, but it's highly unlikely. In fact, I know very few people that are actually utilizing the dollars inside their precious retirement account for a certificate of deposit, especially if it may be a longer term period. So there's a way around the taxability, the tax nature of the certificate of deposit if you're utilizing the CD inside a qualified retirement plan. But generally speaking, people don't use that strategy. That's very uncommon. What would be more common is they just use their dollars, not inside the retirement account, just save it at the bank, maybe for a year, and in return, the bank generates some sort of return for you on those dollars. Here's a graph from the Federal Reserve of a glance at CD rates over 2024. And as you'll see at the bottom, this is from January to July of 2024. Now, notably, the CD rates that were paying out the highest rate of return during this period were the 12-month CDs. And that's not generally true. In most economic situations, the longer term your CD is, the greater the return that the bank will generally pay out to you as the CD holder. But right now in 2024, interest rates are still kind of fluctuating back and forth. Many people are speculating on what the Federal Reserve is going to do here. But for the purposes of this, we're going to compare an infinite banking policy to that 12-month CD rate in 2024. But here's another graph that's demonstrating the difference of these rates of return or internal rates that these CDs were paying back in 2009. And what you'll see here is the orange line, which is a 60-month or 5-year CD, is paying a higher rate than the 12-month CD. And in most normal economic situations, this would be the pattern that you would find. The longer the term, the greater the return. But once again, we're going to focus in on that 12-month CD because we're utilizing our infinite banking policy as a short-term place to store capital before we go and take out a policy loan to maybe go and invest in the future. This is a graph that demonstrates the fluctuation that interest rates have had since the 1980s. What you'll see in the orange line is the 10-year constant maturity yield. This is a 10-year bond, generally a corporate AAA rated bond. And as the Federal Reserve rate, the Fed funds rate changes, which is the purple line, you'll see that those corporate bond yields continue to decrease in lockstep, generally speaking, with the Fed funds rate. Similarly, you'll see the 12-month CD rate in green. It moves very similarly to the Fed funds rate. Now, one thing to note here is that those CD rates change very rapidly, even weekly or monthly. And so as the Fed fund rates changing, so are these CD rates and the payouts of these CDs. It's very, very fluid here. There's no guarantee what a CD is going to pay in the future. So even though we're going to look at a short-term investment strategy, you also could think of this long-term. Is the CD the place that you want to be storing up your capital and earning a return on your dollars? Or is there an ideal saving strategy utilizing the infinite banking concept? In blue there is the dividend scale of one of my favorite insurance companies that I work with and represent. Now, the dividend scale does not equate to an internal rate of return of the policy. A dividend scale shows, relatively speaking, the profitability of the company minus now what their mortality credits were, and then you can figure out what the internal rate of return is. We can look at life insurance policies today and their illustrations, And what an illustration is basically a forecast. If the insurance company were to stay at the exact same level of profitability from the start of the policy to the end of the policy, the dividend rate that you see illustrated would remain the same. But of course, as you see here, with interest rates changing, going up and down, dividend scales and the dividend rate that an insurance company pays out will also fluctuate. Now, it stands to reason, as interest rates continue to climb, it's likely that those dividend rates will also continue to increase over time. Now, why is that? An insurance company purchases long-dated bonds primarily, and in a future episode, we'll look at what are some of the specific characteristics that insurance companies are utilizing premium dollars for. What's important here is as time goes on, they need to roll over those bonds. And as interest rates go down, they're rolling over bonds into a lower and lower yield, hence the dividend scale being adjusted downward. But in a rising interest rate environment, now they're rolling their bonds into higher yield bonds. And so therefore, it's likely that the dividend will also increase from our insurance companies, which we want. We want to encourage that because that means our insurance company is being more profitable and we are mutual owners of that insurance company. So of course, it pays greatly to be rewarded with a profitable insurance company because we are part owners of it. So all this to say here is that saving your cash, even short term, inside a CD is not going to pay out as well as saving it inside of your life insurance contract for a couple of reasons. The tax treatment alone, if you're saving inside a CD in a taxable nature, you're jeopardizing a lot of that return is just being poofed on to taxes. Whereas inside of a life insurance policy, these grow tax deferred. But you also have the benefit of utilizing long-term bonds, even though you may be using cash relatively quickly or the cash value relatively quickly from your policy. So these are just some of the reasons why it pays to save inside of your life insurance contract. But now let's take a look at an example of somebody who maybe they're ready to invest. They've looked at these saving strategies. We're going to compare if they were utilizing the 12-month CD rate versus inside of their life insurance policy. And let's just see which one's going to win out at the end of the day. So here we have it, a CD versus IBC. On the left-hand side, you'll see there that we're going to be saving inside a 1-year CD, and we're going to assume a generous 2%. Right now, CDs are anywhere from 1.5 to maybe 1.8 for a 12-month CD, but we're going to assume 2%, giving them the benefit of the doubt. At the end of the first year, that 2% yield that they've earned from their CD would mean that their account value shows $102,000. But because it's inside a taxable nature, we have to subtract out some of that yield because it's being lost to taxes. So at the end of the first year, now they've got $101,768. Let's compare this to an infinite banking type policy. It's very common right now for us to be able to determine the internal rate of return of cash value life insurance. And it's very easy to see that it's at least 3.5%, maybe sometimes approaching 4%, depending on how the policy is structured. So here we're going to assume a 3.5% internal rate of return. At the end of the first year, we have $103,500, and it stays just at that because it was tax-free growth. We aren't losing some of that return to taxes. But now, in year 2, we're ready to invest those dollars. The CD guy, he invested his $101,768 at a 10% return. At the end of the second year, let's just assume that he didn't have to pay taxes on that 10%. That was net him $111,944. His net return then over those 2 years was $11,944. If we were to annualize that over the 2-year life term, his annualized rate of return was 5.677%. Now let's compare this to the IBC method. With the IBC method, remember, he's starting out year 2 with a leg up. He's got $103,500 able to invest. At the end of the second year, he's also generated a 10% return, and we're going to assume once again that there are no taxes that he's being charged with that rate of return. So at the end of the second year, his net return was $12,297 for an annualized rate of return of 5.813%. So what we've done here is we've shown, even if you're just utilizing infinite banking for a short-term savings strategy, it's going to outperform all other saving strategies before he's ready to invest. And even as he took out the policy loan and paid the interest back to the insurance company, his net return was still much better than the guy utilizing a CD for his saving strategy. And if you were to expand this over a long term, you'll see that IBC outperforms it even better because of the uninterrupted compounding growth that occurs inside these life insurance policies that a CD would never be able to provide. Well, maybe I've given it away just a little bit as to how this is possible, but let's just take a little bit deeper dive into the nature of how can this work? How does saving with IBC and investing in from your infinite banking type policy, how is this going to outperform any other alternative? Well, it's because we've created a financial tailwind. And this is what Nelson describes as controlling your financial environment. In the book, Becoming Your Own Banker, Nelson Nash describes an airplane flying from Birmingham, Alabama to Chicago, and then from Chicago to Miami. With the wind at the back of the airplane, you've created a tailwind. It's propelling the plane to move faster, even though he's burning the same amount of fuel. And so what we're doing here is we're creating our own financial tailwind. We're controlling the environment that our dollars are in. And because it's an uninterrupted compounding growth of our dollars inside the insurance contract, our returns are going to outperform any other sort of saving and investing strategy here. We also couple that uninterrupted compounding with the tax-deferred growth of those dollars inside the life insurance policy. And we've already noticed that a life insurance policy is paying a very competitive return relative to other saving strategies. Even the best saving strategy in 2024, which was that 12-month CD, your insurance contract, your whole life insurance policy was yielding a much more competitive rate of return as a saving strategy before this guy was ready to invest. So here's just another demonstration of saving and spending with traditional banks. But I want you just to focus in on the bottom side of that picture, infinite banking with whole life. And this is what I'm trying to demonstrate. We're going to have an uninterrupted compound growth. It's going to move up like a hockey stick. Whereas utilizing that CD, he's interrupted the return that he would have earned from the CD once he's taken those dollars out and invested it and generated the same return that somebody utilizing an IBC policy would be generating. So this is the magic. This is the beauty behind a properly structured whole life insurance policy for the purpose of becoming your own banker. Not only can we solve our own banking function and the need for finance and recapture the interest that we were paying to third-party lenders, but now we've got an acceleration, a boost in our investing capability because of the uninterrupted, tax-deferred, competitive returns that whole life insurance is providing today. Well, I hope this episode was insightful for you to see the ideal saving strategy and utilizing the power of a life insurance policy as the first place to store your capital and save before you may be ready to invest. And by doing it this way, we've already shown you the uninterrupted compound growth potential of your life insurance policy. If this is something that you're interested in learning more about and would like to work with us, you can go ahead and visit our website, www.capitalcontrol.org, or email me directly, derek@capitalcontrol.org, and I'd be happy to sit down and schedule a 30-minute free strategy session for you to see the power of becoming your own banker. In the next episode, we're going to dig a little deeper into investing and some of the risks inherent, and in particular, What happens when it comes time for you to retire and you need retirement income? What are some of the best strategies in place today to generate a safe and stable future passive income in your retirement years? I hope you join me then, and I'll see you in the next episode. Thanks.